When stock prices are high, investors have found themselves wondering about two things: whether they should sell some stock for gains or wait for lower prices and make an investment only then. The more money someone is sitting on, the more inclined they are to wait for the perfect moment and therefore time the market, because it is stressful looking at your pile of cash knowing it can lose most of its value the day after you invested. But is it worth waiting? Let's see what the data says and what are the best investment strategies out there. I'm Artur Nagy, an economist, and I love sharing finance-related videos, so a massive thank you to everyone who likes, subscribes, comments, shares a video, because you make it possible that we can help other people. Let's get going. The idea of market timing is buying at the right time when it's the cheapest and selling at the right time when it's the most expensive, so you can realize the highest potential gain. But in order to buy and sell stocks at these times, you would have to be able to identify these times, and that is incredibly difficult, if not impossible. See, whenever I talk about stock market investing, I always mention or represent the side that wants to communicate that in investing, everything comes down to your assumptions. Here's a thought experiment. If a company's shares are trading at $50, is that cheap or expensive? Even if it seems expensive, we don't know what the future holds, and compared to their performance in 10 years, today's expensive prices might be an amazing deal. We just don't know because we can't observe the future. So how do you know if you're at a point where you have to buy or sell these shares so you can perfectly time the market? Someone might look at a price graph, you might have seen those busy charts traders use, or you can look at company fundamentals like I do and use one set of criteria to arrive at the ideal price, but then someone else might use a different set of criteria to arrive at another ideal price. Just like how analysts estimate different price targets for companies. And so you can see that the prices we put on companies differ and that there is no cookie cutter approach that would tell you which price is good and which price is bad. If such a method would exist, we would have probably heard about it, everyone would be filthy rich by now, and capitalism would collapse on itself because there is only so much money to go around. Anyhow, again, everything comes down to your assumptions. Everything comes down to your assumptions. What you think will happen with the company and their share price given all the information available to you. To further highlight the difficulties in timing the market, let's remind ourselves that the majority of the stock market's returns happen in a small number of trading days that you want to be a part of if you want to maximize your return. Here's an example. A 2014 JP Morgan study looked at a 20-year period between 1993 and 2013 to find that compared to buying and holding, so being fully invested, taking away the 10 best days, you would miss out on 3.7% of the gains, which would result in your ending balance being 50% lower. Looking at a 40-year period when investing in the S&P 500 and taking away the best days yields a similar result. It goes to show how important it is to be invested when the market is having its best days. Now, in all fairness, if you're not invested, you are just about as likely to miss out on the worst days as well, so this is more of an extreme case, but very important for someone who knows how to recognize these days and wants to time the market. Which, if you haven't gathered up until this point, I don't particularly recommend for most people, because you have to be right 2 times. Whenever you buy before the best days and whenever you sell before the worst days. Over and over again. I have identified the worst day once, it worked out amazingly, but let's be real for a second, it would be incredibly difficult to replicate that every single time. And we know an average investor underperforms the S&P 500 and the market, let alone an average investor who tries to time it. Furthermore, let's not forget about the associated potential transaction fees and taxes incurred because of more frequent transactions. For all these reasons, there are investment strategies other than timing the market that could also work. That's what a 2021 Charles Schwab research looked at. They examined all possible 20-year investing periods starting from 1926 and wanted to see how 5 different investing styles compare against each other and how much money they make if they give them each $2,000 at the beginning of every year for 20 years, imitating a year-end bonus, tax refund, stimulus check, or a pay raise. The investing styles are perfectly timing the market, investing immediately, dollar cost averaging, bet timing, and staying in cash. Before we dive into the results, let's spend a minute on understanding what each of these styles do and how they approach the task. Perfect timing assumes someone incredibly skilled or lucky who invests their $2,000 each year at the lowest point of the market, so theoretically they have the largest room to grow. Investing immediately is, as the name suggests, every time they get their $2,000 at the beginning of every year, they invest it straight away at the first trading day in full. Dollar cost averaging is the idea of dividing up your money and investing it over time. Every time this hypothetical participant receives their $2,000 at the beginning of each year, they divide it up to 12 equal parts and invest one part at the beginning of each month. Bad timing is the opposite of perfect timing and would indicate someone who is so unlucky to invest at the highest point of the market each year where prices are most expensive, theoretically limiting the gains they could make on their investments. And last but not least, staying in cash. This person never got around the idea of investing in stocks and was always waiting for lower prices and better opportunities to invest. In the research, this person's money was tracked by investing in 30-day US Treasury bills, which come with a lower interest rate but are much more stable and are safer than stocks. That's why the amount you will see will not exactly be $40,000. I just wanted to mention that. So after looking at 76 20-year periods, in 87% of the cases the ranking looked like this, and here's a graph showing the period between 2001 and 2020. Naturally, perfect timing came out on top, but that's impossible to do, so let's not worry about that too much. What's surprising is that investing immediately, lump sum investments, regardless of what the market was doing, came in second just before dollar cost averaging. And even investing at the worst possible time each year fared way better than just sticking to cash and losing value due to inflation. Or in this case, investing in treasury bills for a minimal return that's usually lower than inflation, so also losing value in the process. The research also points out that in this case, by waiting for better and better opportunities, and as a result never investing the money, people are missing out on way more money compared to the amount of money they would miss out on if they were to just simply invest it immediately or dollar cost average instead of trying and finding the best time to invest it, in which case the difference is much smaller. This gap would be different with different yearly amounts and returns, but I hope it gets the general idea across, which is opportunity cost. If you hold on to your money, you're not able to invest it and therefore miss out on the market's returns. As always, we have to mention these researches and most of the data we have look at past performances, which are not indicators of future performance, as the future can be different. But if history and statistics is anything to go by or anything we can learn a thing or two from, there is that. Make sure to invest in what fits your risk tolerance. So which method should you choose? Even though perfectly timing the market returns superior gains, it is extremely difficult to do over a long period of time, and therefore most people don't consider it as a practical option, more like a theoretical benchmark to compare other options to. I also wouldn't recommend timing the market, as we know the average investor underperforms the S&P 500, let alone someone who tries to time it. People are more likely to wait for better opportunities the more cash they have because of the fear of losing most of the value the following day they invested. However, lump sum investments, or in other words, investing immediately, seems like the best option as it has the best performance in the vast majority of cases. In case you're still hesitant and it fits you better, you might want to consider dollar cost averaging, splitting up your money in equal parts and investing it over time. Let's say one part every 1 month. This can prevent procrastination, remove that initial stress and potential later regret from your life, and ensure that you buy all the lows and all the highs of the market while returning only slightly less than investing immediately, but that might be worth it for some people who value less stress in their lives. If you enjoyed this video, consider subscribing and leaving a like, as that would greatly help me out. Thanks for watching, and until next time.